$38 trillion. That's not a projection. That's not a forecast from some think tank trying to scare you. That is the actual verified national debt of the United States as of December 2025. And if that number feels abstract to you, like it's just some figure on a government website that doesn't really touch your life, I need you to reconsider. Because that number affects the price of your groceries, the interest rate on your mortgage, the value of your savings account, and the future your kids are going to inherit. But here's what nobody is talking about. Right now, quietly, without press conferences or breaking news alerts, the largest financial institutions on the planet are moving massive amounts of capital out of dollar-denominated assets. This is happening for the first time in 75 years. Not retail investors panicking on Reddit. Not some guy on social media with a conspiracy theory. The biggest, most sophisticated money managers in the world, the ones who have teams of analysts reading every line of every balance sheet, are repositioning. And they're doing it quietly. Now, everything I'm about to share with you is based on documented capital flows, public filings, and treasury data. You can verify every single claim. Links are in the description. This is not conspiracy. This is arithmetic. By the end of this video, you're going to understand exactly what is happening, why it's happening, and what comes next. Because here's the part that should really get your attention. There is a mathematical pattern that has repeated 3 times in the last 500 years. 3 times. And each time it followed the same stages, produced the same warning signs, and ended with the same outcome. That pattern is unfolding right now in the United States. So the question is simple. Will you see it coming, or will you miss the signs like millions of people have before you? Stick around. The next 15 minutes are going to fundamentally change how you think about your money. Let's start with the bigger picture, because America doesn't exist in a vacuum. According to the International Monetary Fund, total global debt currently sits at $251 trillion. That represents 235% of global GDP. Let that sink in. That is the highest level of debt relative to economic output in recorded peacetime history. There is no precedent for this during a time when major nations aren't actively fighting world wars. And the United States is leading the charge. In January of 2025, U.S. national debt stood at $36.1 trillion. By December, it had climbed to $38.4 trillion. That's an increase of $2.3 trillion in just 11 months. Not over a decade, not over 5 years, 11 months. Now here's where it gets uncomfortable. This exact scenario, a dominant economic power drowning in debt while the smart money quietly heads for the exits, has played out 3 times in modern history. And in every single case, the reserve currency nation collapsed within 36 months of institutional capital beginning to leave. Not sometimes, every time. The patterns were identical. The stages were identical. The timeline was nearly identical. And the result was identical. It's mathematical. It's predictable. And history tells us that past a certain point, it's unstoppable. So let me walk you through the 4-stage cycle that has preceded every major economic collapse in the last 500 years. Once you see it, you can't unsee it. Stage 1 is what I call ascension. This is the golden era. A nation rises to become the center of global finance. Capital floods in from all over the world. Its currency becomes the standard for international trade. Banks expand rapidly, markets boom, innovation surges, and confidence becomes absolute. Everyone believes the good times will last forever. This stage typically lasts 50 to 80 years, and during it, the nation genuinely is the most powerful economic force on earth. No argument, no debate. It earned that position. Stage 2 is overextension. This is where the cracks begin, but nobody notices because the surface still looks shiny. The nation starts spending far beyond its means. Military campaigns abroad, foreign interventions, massive domestic programs, growing bureaucracies. Debt begins growing faster than the economy, but asset prices keep rising so nobody worries. The central bank prints money to cover shortfalls. Everyone looks at their portfolio going up and assumes everything is fine. This stage lasts 20 to 40 years, and it feels like prosperity, but it's borrowed prosperity, literally. Stage 3 is the silent exodus. This is the stage most people never see because it happens behind closed doors. The smart money, the institutional investors who actually read balance sheets and understand where things are headed, begins quietly rotating capital out of the country and into safer places. Foreign governments reduce their holdings. Wealthy families diversify internationally. It starts slowly, almost imperceptibly, and then it accelerates. This stage lasts 18 to 36 months, and it is the last window where ordinary people can still act. Stage 4 is collapse. The currency loses its reserve status. Foreign central banks dump their holdings. Inflation doesn't just rise, it explodes. Interest rates spike. Asset prices crash, banks fail, pensions vanish. The middle class is destroyed in a matter of months, not years. Political chaos follows. And everyone, from politicians to media to your neighbor, asks the same question. How did we miss this? They missed it because they didn't know what to look for. But you're about to. Let's go back to the first time this played out in the modern era, Spain in the 1500s. Stage 1. Spain was the most powerful empire on earth. Spanish galleons were crossing the Atlantic and bringing back unprecedented amounts of gold and silver from the Americas. The Spanish real became the global reserve currency. If you wanted to do serious international business, you used the real. Madrid was the financial center of the known world. Capital poured in. Confidence was sky high. Spain was untouchable. Sound familiar? Stage 2. Spain began spending on an extraordinary scale. Endless wars with France, England, the Ottoman Empire, the Dutch. Military deployments stretched across multiple continents. A massive bureaucracy grew at home. Lavish palaces were built. The Inquisition consumed resources. By 1550, Spain was spending 300% of its annual revenue, 3 times what it was bringing in. But gold kept flowing from the Americas and asset values kept rising, so the crown kept borrowing and lenders kept lending. Nobody panicked because the surface still looked golden. Stage 3. In 1555, something critical happened. The powerful Spanish banking families began quietly moving their operations to Genoa. They could see the books. They knew what was coming. The Fugger banking dynasty, one of the largest creditors to the Spanish crown, started demanding repayment in gold rather than promises. By 1556, merchant capital was gradually shifting to Amsterdam. Interest rates in Spain climbed to 40%. 40%. When lenders demand that kind of return, they're not pricing in risk. They're pricing in near certainty of default. The smart money was gone. Stage 4 hit like a freight train. Spain defaulted in 1557. Then again in 1560, again in 1575, again in 1596, and again in 1597. 4 defaults in 40 years. Credit markets froze completely. Spanish bonds became worthless. Inflation devastated the middle class. The empire that had ruled the world just decades earlier was broken. By 1600, Spain's era of dominance was over. And where did all that capital go? Straight to the Dutch Republic, which brings us to the second time this pattern played out. The Dutch Republic in the 1600s. Stage 1 was extraordinary. Amsterdam became the richest city on the planet. The Dutch East India Company, at its peak, was worth the equivalent of $8.28 trillion in today's money. Let that number register. That's larger than Apple, Microsoft, and Amazon combined. The Dutch invented the first stock exchange. The guilder became the global reserve currency. Capital flowed in from every corner of Europe. Amsterdam was like Silicon Valley, Wall Street, and the City of London all merged into a single square mile. It was the undisputed center of global commerce and innovation. And I want to pause here to mention that every figure I'm citing comes from official Treasury reports, IMF data, and congressional records. All of it is linked in the description below. Verify it yourself. This is not opinion. This is the historical record. Stage 2. The Dutch began fighting wars on multiple fronts. 3 Anglo-Dutch wars against England, conflicts with France and Spain, military operations stretching from Indonesia to Brazil. National debt exploded from 4 million guilders to 80 million guilders. That's a 20-fold increase in 40 years. The government printed money to cover the gap. And then something fascinating happened. Asset prices completely detached from reality. You've probably heard of tulip mania, where single tulip bulbs were selling for more than houses. That wasn't just a quirky historical footnote. It was a symptom of a money supply that had lost all discipline. Meanwhile, the Bank of Amsterdam, supposedly the most trustworthy financial institution in the world, was secretly engaging in fractional reserve lending to fund wars. It was, in the most literal sense, running a Ponzi scheme. And insiders knew. Stage 3. Starting around 1690, the great banking families began moving their operations to London. Sephardic Jewish merchants, Portuguese traders, German financiers, they all began systematically pulling their capital out of the Dutch Republic. This wasn't random. This wasn't emotional. These were sophisticated financial operators who had access to information the general public didn't. Many of them had known since 1672 that the Bank of Amsterdam was effectively broke. They had 18 years of quiet preparation. The public had no idea. Stage 4. In 1795, France invaded and the entire system came apart. The guilder collapsed. The Bank of Amsterdam's fraud was exposed for all to see. Depositors lost everything. Riots broke out. The Dutch Golden Age, one of the most remarkable periods of prosperity in human history, was over. And where did the capital flow? To London, to Britain. Which brings us to the third and most recent example before America, the British Empire. Stage 1 was staggering in scale. At its peak, Britain controlled 23% of the world's population and 23% of its landmass. The British pound served as the global reserve currency for over 200 years. London was the undisputed hub of international finance. Britain financed railroads, ports, and infrastructure across the entire globe. 60% of all international trade was conducted in pound sterling. The gold standard itself was built around the pound. This wasn't just dominance. It was a system so deeply embedded in global commerce that most people couldn't imagine it ever ending. Stage 2 began with the First World War. That single conflict cost Britain $44 billion, which is roughly $600 billion in today's money. National debt went from 30% of GDP to 130% of GDP in just 4 years. Then the Second World War made it worse. Britain had to borrow heavily from the United States just to survive. The gold standard failed in 1931 and again in 1933. The foundation of British financial dominance was cracking, but the empire still stood, so people assumed it would hold. Stage 3. Starting in 1949, the institutional exodus began. Major British corporations like Unilever, Shell, and BP started shifting their primary investment activity to the United States. Wealthy British families moved assets to Switzerland, America, and Canada. Britain experienced a massive brain drain as its best scientists and engineers left for better opportunities abroad. Foreign direct investment into Britain dropped by 62% by 1960. The smart money was leaving, methodically and deliberately, and the average British citizen had no idea what it meant. Stage 4. In 1967, the pound was devalued by 14.3%. In 1976, Britain was forced to go to the International Monetary Fund for a bailout. A bailout. The nation that had ruled global finance for 2 centuries had to ask for emergency loans. The pound lost its reserve currency status. International trade shifted to dollars. British dominance was over. Not with an invasion or a revolution, but with a slow mathematical unwinding that followed the exact same pattern as Spain and the Dutch Republic before it. Now here's where I need you to pay very close attention, because when you lay the American timeline next to these 3 examples, the alignment is not close. It's exact. Stage 1. In 1944, the Bretton Woods Agreement established the US dollar as the world's reserve currency, backed by gold. In the aftermath of World War II, capital flooded into the United States from every corner of the globe. America's period of unchallenged financial dominance ran from roughly 1945 to 1971. 26 years of absolute supremacy. Stage 2. In 1971, President Nixon ended the dollar's convertibility to gold. That single decision removed the last restraint on government spending. And what followed was an explosion of debt that has no historical parallel. In 1980, U.S. national debt was $900 billion. By December of 2025, it's $38.4 trillion. That is a 4,200% increase in 45 years. And that's just federal debt. When you add household debt, corporate debt, state and local debt, and unfunded liabilities, total U.S. debt exceeds $100 trillion. That's 370% of GDP. The government is now paying over $1 trillion per year just in interest on the debt. Not reducing it, not paying it down, just servicing it. Meanwhile, the M2 money supply increased by 40% between 2020 and 2022 alone. The Federal Reserve's balance sheet went from $800 billion to $9 trillion. And asset prices? Housing is up 73% since 2019. Not because houses got 73% better, because the money measuring them got that much weaker. We are deep into stage 2. The overextension is not a theory, it's on the balance sheet. And stage 3 is happening right now. China held over $1 trillion in US Treasuries in 2013. Today that number is $760 billion and dropping. Japan, America's most reliable ally and creditor, has reduced its holdings by $220 billion since 2022. Saudi Arabia is selling, Belgium is selling, Switzerland is selling, France is selling. The Federal Reserve itself has been engaged in quantitative tightening, reducing its own holdings. So who's buying? Increasingly, it's circular. The U.S. government issues debt, the Federal Reserve or government-adjacent pension funds buy it, and the system pretends that constitutes real demand. Meanwhile, the biggest institutional players in the world are diversifying. BlackRock, JP Morgan, Goldman Sachs, Morgan Stanley, Bridgewater, they're all increasing allocations to emerging markets, European assets, Asian assets, and gold. They're not making public announcements about it. You won't see a press conference. But the capital flows are documented. The filings are public. The money is moving. This is the silent exodus. And if the historical pattern holds, stage 4 follows within 18 to 36 months of it beginning. So what does stage 4 look like for America? Based on the pattern, the dollar doesn't lose reserve status overnight. It happens gradually, then suddenly. We're already seeing the gradual part. China and Brazil are conducting bilateral trade in yuan. India and Russia are settling transactions in rupees. The BRICS nations are actively developing alternative payment systems designed to bypass the dollar entirely. Saudi Arabia, the linchpin of the petrodollar system since the 1970s, has openly discussed accepting yuan for oil. The petrodollar framework, one of the last pillars supporting dollar dominance, is fracturing. When enough international trade shifts away from the dollar, the trillions of dollars held overseas begin flowing back to the United States. That sounds like it might be a good thing until you realize what it actually means. A flood of dollars returning home with no corresponding increase in goods and services means one thing. Inflation goes vertical. Not the 5 or 8% we've been complaining about. The kind that fundamentally reprices everything in the economy. The Federal Reserve then faces an impossible choice. Raise interest rates high enough to defend the currency, which makes the existing debt completely unpayable and triggers a depression. Or print more money to cover obligations, which accelerates inflation toward hyperinflation. There is no door number 3. Asset prices crash. Banks that are over-leveraged fail. Pension funds that are loaded with treasuries and mortgage-backed securities get wiped out. The middle class, whose wealth is concentrated in homes and retirement accounts, gets destroyed. Not reduced, destroyed. Now I know what some of you are thinking, and I want to address it directly because these counter-arguments matter. The most common response is that America is different. We have the strongest military in the world. We have Silicon Valley. We have the best universities. We have unmatched innovation. And all of that is true. But Spain had the most powerful military in the world when it collapsed. The Dutch Republic was the innovation capital of its era, inventing modern finance itself when it collapsed. Britain had the largest empire in human history and the most prestigious universities on the planet when it collapsed. Having the best military, the best technology, and the best institutions did not save any of them, because the pattern isn't about military strength or innovation. It's about debt mathematics. And debt mathematics doesn't care about your aircraft carriers. The second argument is that the Federal Reserve can just print its way out of any crisis. It can create infinite money. And technically, yes, a central bank can print unlimited currency. But Weimar Germany proved what happens when you do. Zimbabwe proved it, Venezuela proved it, Argentina is proving it right now. Printing money doesn't create wealth. It redistributes it from the middle class and savers to the government and those closest to the money spigot. Hyperinflation doesn't solve a debt crisis. It detonates the middle class. This pattern doesn't care about narratives. It doesn't care about American exceptionalism. It doesn't care about which political party is in power. It unfolds like math. It unfolds like gravity. You can disagree with it, but you can't negotiate with it. So what do you actually do with this information? Because understanding the pattern is only useful if it changes your behavior. First, diversify away from purely dollar-denominated assets. That means considering gold, silver, commodities, and real assets things that have tangible value regardless of what any single currency does. These aren't speculative bets. They're the same assets that have preserved wealth through every previous stage 4 in history. Second, think about geographic diversification. That doesn't necessarily mean moving to another country. It means holding some assets or some currency exposure outside the US dollar. The Swiss franc, the Singapore dollar, the Norwegian krone, these are currencies backed by nations with strong balance sheets and low debt relative to GDP. Third, understand the timeline. Stage 3 historically lasts 18 to 36 months. Based on the capital flow data, we appear to be roughly 12 to 15 months into it. That doesn't mean stage 4 starts tomorrow, but it means the window for preparation is not unlimited. Fourth, increase your liquidity. Having cash or cash equivalents available during a crisis gives you options that other people won't have. When asset prices crash, liquidity is king. The people who came out of every previous collapse in the best position were the ones who had dry powder when everyone else was forced to sell. Fifth, reduce your debt exposure. If interest rates spike, which they do in every stage 4 scenario, variable rate debt becomes a trap. Fixed rate debt is more manageable, but carrying excessive debt of any kind into a period of financial instability is dangerous. Sixth, and this one gets overlooked, build your skills and your relationships. In every major economic disruption throughout history, human capital, what you know and who you know, survived when financial capital didn't. Skills that have real-world value, relationships with people you trust, communities you're part of, these things are more durable than any portfolio. And seventh, stay informed. Keep watching this channel, because this story is going to evolve rapidly over the coming months, and I'm going to be tracking every development. In the next video, I'm going to break down exactly which assets and which sectors have performed best during stage 4 historically. We're talking about what gold did during the British decline, how real estate behaved during the Spanish collapse, and how specific types of stocks actually perform during these crises. Because here's the thing that most people don't realize. Stage 4 doesn't destroy all wealth, it transfers it. And the people who understood where it was flowing got wealthier, not poorer. This video is not about fear, it's about pattern recognition drawn from 500 years of documented financial history. The same stages, the same signs, the same timeline, 3 times before, and now the data suggests a 4th. The question isn't whether you believe it. The question is whether you're positioned for it. So here's what I need from you. Drop a comment below. Tell me what you think. Tell me what you're doing to prepare. Tell me where you disagree. Tell me your questions. I read every single comment and I'll be responding. If you're not subscribed yet, hit that subscribe button and turn on the bell notification, because the next video on which specific assets outperform during stage 4 is one you do not want to miss. The pattern is unfolding whether we like it or not. The only variable is whether you act on the information with clarity and courage, or whether you look back in 3 years and wish you had. I'll see you in the next one.